If you are self-employed or own a small business, there is a powerful deduction built into the tax code that too many people either overlook or misunderstand: the qualified business income deduction, or QBI for short. Hi, I'm Aradhana Aggarwal. I am a CPA and my goal is simple: to help everyday people understand taxes without fear, confusion, or jargon. And today we are breaking down what it is, who qualifies, and how you can use it to legally lower your tax bill by as much as 20%. Let's start simple. The QBI deduction was introduced under the 2017 tax reforms to give small business owners a tax break similar to the corporate tax cuts bigger companies received. In plain English, if you are a sole proprietor, partner, or S corporation shareholder, you might be able to deduct up to 20% of your business profits without spending a single extra dollar or making a new purchase. It's an automatic reward for generating business income. Here is how it works. Suppose your business earns $100,000 of profit. Under the QBI deduction, you could deduct $20,000 directly from your taxable income. That means you will only be taxed as if you earned $80,000, a huge savings, especially since it reduces both your federal rate and in some cases your state taxes too. So who qualifies? You must have qualified business income, which generally means profit from a US-based trade or business, including most freelancers, independent contractors, consultants, and small partnerships or LLCs taxed as pass-through entities. C corporations don't qualify. If you get a 1099 NEC, run a sole proprietorship, own rental property reported on Schedule E, or hold part ownership in a partnership or S corp, you are probably eligible. But there are limits. The deduction starts to phase out if your total taxable income, not just business income, exceeds certain thresholds. Once you pass those levels, your QBI deduction may shrink or disappear depending on what type of business you run. That brings us to the next piece: specified service trades or businesses, a term that IRS uses for fields like health, law, accounting, consulting, financial services, and performing arts. If you are in one of these professions and your income exceeds those thresholds, your deduction phases out completely. But if you are under the limit, don't worry, you get the full 20%. If you are over, there are still strategies that you can use. These include shifting income into retirement contributions, accelerating expenses, or even adjusting ownership structures to bring taxable income below the limit. Now, for businesses that aren't service-based, things like manufacturing, e-commerce, or certain real estate operations, the phase-out rules work differently. Once you pass the income limit, your deduction is capped by a formula based on W-2 wages paid and the value of business property. That's the IRS's way of saying if your business supports jobs or invests in assets, you may still qualify at a higher income level. Let's make it concrete. Imagine you run an S corporation with $250,000 in profit and pay yourself a $100K salary. That's your reasonable wage. Your taxable business income is $150,000. If you are married filing jointly and under the threshold, you might deduct 20% of that $150,000, $30,000 of your taxable income. Now imagine your income jumps next year, crossing the threshold. With some planning, like increasing retirement contributions or purchasing equipment before year end, you can bring that back down within qualifying range. What's great about the QBI deduction is that it's in addition to all your other deductions. You can still deduct your expenses, depreciation, home office, and retirement contributions, then apply up to 20% of the remaining profits. A few key details business owners often miss: is not automatic. The tax software or preparer needs accurate records of business profit, wages, and property. One wrong category can delete your deduction. Rental income may qualify if you are actively managing the property. Passive investors might not. Documentation and time logs help prove eligibility. Losses carry forward. If your business takes a loss this year, it reduces next year's QBI. Consistent bookkeeping matters. Here is the bottom line. If you generate self-employment or small business income, the QBI deduction could be one of your biggest tax savers. But it only pays off if your income is tracked, categorized, and planned strategically. So before year end, review your projected income, check whether you are above or below the phase out limits, adjust through retirement contributions or business investments if needed. Saving 20% on your taxable income without spending an extra dime, that's the kind of planning every small business deserves. Thanks for watching. See you next week. And don't forget to like and subscribe for more tax tips that are legal, practical, and intentional.